There are some companies out there, major mutual companies, and they don't like infinite banking. Does that mean infinite banking is bad? No,
not necessarily.
But why don't they like it, Nick?
Well, for one thing is there's a couple of things. One is they want you buying other products. They want you putting, they've got a shtick on how you're going to fund your whole life policy. They want you to direct the dividends to pay your premiums. And then that's part of their sales stick that, hey, you won't have to pay any out of pocket dollars to this policy. And guess what? You can put money in these other products that we're trying to sell you. Right.
So, yeah, one thing we have to remember, especially when we're doing infinite banking, and Nelson talks about this and he writes about it very eloquently, is these are large financial institutions. So what does a financial institution want?
They want control of your money.
And how much of your money do they want?
As much as you'll part with.
How long do they want to keep it?
As long as you'll tolerate it.
And how much do they want to give back to you?
As little as you'll tolerate.
That's right. So, these insurance companies, that's what they want. Now, if they're going to do infinite banking, we're going to take their money and go make money while our money sits with them inside of a tax shelter, right?
Right. So
the company has to like it. Now, why would a company like it? Well, right now, let's say that an insurance company is charging you 5% on a loan, which is 100% secure asset to the insurance company. Is there anywhere else that they can get 5%, 100% secure in today's market?
Not likely.
No. So there are insurance companies that understand that this is a good thing to have people doing infinite banking that are their policyholders. But the majority of people will never take a loan on their life insurance policy. The majority of people will not do infinite banking, and the majority has never been right about anything, as Nelson again pointed out all the time. Right? So we are in the minority. I am okay with that. And in fact, I embrace that. Okay. So these insurance companies that don't like infinite banking, how do we know they don't like infinite banking? Well, Nick talked about Nelson's book, Becoming Your Own Banker, which is really the standard. And that's a book that everybody listening to this, if you have any interest in infinite banking, you got to read that book at least 100 times. No, I'm just kidding. At least a couple of times. And that book lays everything out very, very clearly. Now, there was an insurance company, Northeast large mutual company, okay, that we won't mention. But what they said is that if you hand out that book and you're a career agent with them, okay, you'll be terminated. This is about 3 or 5 years ago, something like that. Now, would I want to buy a policy and do infinite banking with that company and knowing that they would terminate a career agent if they promoted infinite banking with Nelson's book? No, because what's next, Nick?
That's right. That's next. Now they don't support the process of infinite banking. Because remember, infinite banking is not about the product. It's about the process of taking loans, paying them back, rinse and repeat. And in my mind, that sends a signal that, hey, they're not going to tolerate that business for who knows how long, and then support the process of it. And that's one of the things we've seen this before, is when a company changes their tolerance level, how cumbersome it becomes to do the process of banking with an insurance company that doesn't want to service the business anymore.
Absolutely. So, and here's one small example, is that we have companies that we use that can get you a loan, sometimes, no promises, sometimes the same day. Okay. But within 24 hours.
Yep.
And so we can move quickly, especially if we're a real estate investor or we simply got caught flat-footed on owing some taxes or something like that. I've seen this stuff happen over and over again over the years. So there are companies out there that take weeks to get a loan. And what they're doing is they're discouraging you from taking loans because they're a financial institution that wants your money. How much? All of it. How long do they want to keep it? Forever. How much do they want to give back to you? None. As little as possible. So remember that over and over again. Okay. So those companies, they're just hard to work with.
Sure.
You know, and so we don't really want those companies either. There are also companies that I think are when you look at illustrations, they're showing you dividends. And by the way, when you see an illustration from any company and the non-guaranteed, the current scale, current dividend scale projection, that will not happen. Okay, just know that will not happen. It's going to be better, it's going to be worse, but it will not be every year that amount. And so the only thing that we can do then that we know for sure is the guarantees. So we want those guarantees have weight. I think more weight than somebody robbing their reserves to prop up their dividend. So guarantees are really, really important.
Yeah, there's very few. I mean, think of it like almost like a risk transfer, right? Like, so if a company is showing there's no good deals in insurance, right? So where they giveth, they taketh. So if a place is showing you this really high dollar figure in a dividend, well, guess what? It's coming out of the guarantee. So what have they done? They've transferred the risk to you by saying, hey, I'm going to have this cash value here if I get paid the dividend, right? If the company goes, hey, we're not going to pay out these big dividends, but in return, you're going to get this really high guarantee. Well, who just took the risk to perform? Well, the insurance company did. Well, do I want to bet? I kind of think about it. Do I want to bet with or against them? Well, they have actuarial science, the law of large numbers, selection on their side. So these companies we're working with have been around for only over 100 years, right? They've only paid dividends for only over 100 years, right? So they've got a heck of a track record to do this. I'm going to go with them and their guaranteed number. That's what I'm drawn to,